A pleasant good evening to you all, and welcome to today's discussion, Entrepreneurs and Taxation. This discussion is brought to you courtesy Western United Credit Union Cooperative Society Limited. This evening, topics include income tax for sole traders, business levy, employee statutory taxes, value-added tax obligations, and property tax essentials. You will gain valuable insights from Colin Ramsey, partner at Ernst & Young. With over 24 years of experience, Colin guides domestic and international clients through tax complexities in Trinidad, Tobago, and Guyana. Also joining us is Risa Young, a seasoned expert at Ernst & Young with over a decade of experience. Specializing in pay-as-you-earn, VAT audits, and tax compliance, Risa provides valuable guidance to clients in various industries, expertly handling tax returns and disputes. At this time, we would like to take this special opportunity to introduce our host for this exciting discussion, Mark A. Ferret, President of Western United Credit Union, an inspiring lecturer, entrepreneur, advocate for superior customer care, and credit union and cooperative societal specialist. Mark has over 38 years of cooperative management experience. Welcome, Mark, and welcome all. Thank you for joining us today.
Everyone, I welcome you to our first webinar for 2025, and I promise you that this webinar, these 2 days, will be a very exciting, very informative, very life-changing webinar that will help you with your tax, and that, of course, will help you in improving your business. But as is customary at WESCU, Western United Credit Union Cooperative Society Limited, we don't do anything without God, without inviting God in our presence and for Him to take over the entire experience that we are going to have. So at this time, I would invite Ms. Dixian J. D'Souza, our worship leader at the credit union and our former secretary of the board of directors, to lead us in a word of prayer.
Thank you, President Mark. Let us bow our heads and close our eyes as we invite our Heavenly Father into our webinar. Heavenly Father, we gather here today with grateful hearts for this opportunity to learn, share, and grow as entrepreneurs and stewards of our communities. We thank you for the gift of knowledge and the chance to deepen our understanding of the vital topic of entrepreneurs and taxation hosted by the Western United Credit Union Cooperative Society. As we commence day 1, focusing on know your tax responsibilities and stay compliant, we seek your divine guidance and wisdom. Bless the minds and hearts of all participants, that they may gain the clarity and tools to navigate their tax obligations with diligence, integrity, and confidence. Lord, we lift up our esteemed speakers before you. Mr. Colin Ramsey, a seasoned expert and partner at Ernst & Young Services Limited. With his wealth of experience, may he enlighten us with his insights and inspire us to make informed decisions. Lord, bless Ms. Risa Young, a dedicated professional with expertise in PAYE, VAT audits, and tax compliance. Bless her as she shares her knowledge to help us stay compliant and steadfast in our financial responsibilities. And Lord, Mr. Mark A. Ferret, our president, our host and president of WESCU, a passionate leader and advocate for progress in the cooperative movement. May his leadership and wisdom inspire us to embody excellence in all that we do. We ask for your blessings on this webinar, its organizers, participants, and all those who have worked diligently to make it a success. Guide our discussions and grant us the grace to to leave this gathering empowered, inspired, and ready to make meaningful contributions to our families, businesses, and communities. In the name of Jesus, your holy name we pray. Amen.
Amen. In the name of the Father, and of the Son, and of the Holy Spirit. Amen. Thank you so very much, Madam Secretary, former Secretary of the Board of Directors. I thank you very much for your support and dedication, as always, Ms. Dixian J. D'Souza. Good evening again, everyone, and welcome to your worship station. Welcome to this evening's webinar, where, of course, I said it would be a very exciting webinar. And as we get into it, I want, of course, you would have heard Colin Ramsey. He is going to be one of our speakers, property tax specialist. And you would have heard about Miss Risa Young, tax staff specialist. And these two young and brilliant minds are going to take us through this evening's session. But before we start, I want to ask all of you a favor. I want you to get your entrepreneurial journal. Yes, yes, yes. Giving you all a minute. Run to the study. Call the children. Ask them to bring something for you if you don't have an entrepreneurial journal. Because as I promise you, this is going to be a very enlightening evening. And I want you all to be taking your notes. And I also want you all to answer certain questions for me as you go through this evening. I want to first ask the question, how do you look at your business? That is very critical. How do you look at your business? Do you look at your business as a vocation or a hustle? And if you look at it as a hustle, then we need to change the way that we speak, because your business, whatever your talent is, whatever your gift is from God, it is not a hustle. It is a vocation that will continuously impact and help people to gain whatever they want from your business. So words matters, thoughts matters. What is your vision? What is your business vision? What is your mission? And what is your core values? So we need to think about these things as we go through these 2 days of entrepreneurs and taxation. So I am guessing that you all have your entrepreneurial journal by now. And if you don't have one, you know what we have to do. We have to get an entrepreneurial journal, because we are going to be journalizing what we have heard this evening. We are going to be taking note. We are going to be drawing a map of where we desire our business to go thereafter. So this evening, as we come together as a team, as a family, we are coming with an open mind and open heart, and we are coming here to learn. So in learning, we know that at times we have to unlearn. So we are going to leave ourselves open, and we are going to unlearn. And by the end of the sessions, we are going to relearn new things to empower us to make ourselves better entrepreneurs. So with that being said, I want to introduce to you Colin Ramsey, my dear friend and alma mater.
Absolutely.
Boston Francis College. And I want to introduce to you as well Risa Young, very intelligent and beautiful young lady who I got to know last year. And we have been working together, partnering together to ensure that members at Westview and also the wider community throughout Trinidad and Tobago are empowered to enhance their business and also to take care of their personal lives as well. So, Colin.
Well, thank you for that introduction, Mark. good evening to you, the support cast, all the members and participants on this webinar. We are going to be discussing the area of taxation. It is intended that the session be a rewarding one to you, where we impart the knowledge of the basics and the fundamentals in tax. And to me, the most gained out of sessions of this nature would come from the Q&A part of the presentation, where you really put out the questions based on your practical encounters running your business or being employed, as the case may be. Any issues that you may want clarified, now is the opportunity to do so.
And we do have someone manning the Q&A, the chat, Mr. Aaron Williams, and he is going to be paying particular attention to that area. So from time to time, I'm going to ask him if there are any questions in the chat, and we are going to address it once. You will take questions in between, Colin, but I know that we have a specific period at the end of it where we are going to take questions from the participants.
That's correct. So thank you, Aaron, for facilitating the questions that will be asked during the session. So I'm going to run through some slides which Risa actually prepared. So I want to thank Risa for all her hard work and putting together these lovely slides that I'm about to present. So perhaps you could let me know once my screen is up. And
yes, I am seeing the presentation.
Yes, so I'm just going to switch the slideshow. So good. So I'm just going to kick off. And today's agenda, as Mark would have mentioned, covers income tax obligations for a sole trader. We're also going to look at business levy, which in general terms is a minimum tax that is applicable, and it is normally based on the gross income of a person or company. We're going to look at employee statutory taxes, because individuals fall within different tax regimes. So individuals who are self-employed or have their own business would typically pay income tax. And as we go through the presentation, we would see how that income tax is accounted for in respect of those sole trader type arrangements. But for persons who are employees of organizations, they would fall under what we call the pay-as-you-earn system, abbreviated PAYE system, which shifts the responsibility of accounting for income taxes on the employer of those persons. So once you are an employee, you are not responsible essentially for accounting for your income tax. Rather, your employer has the responsibility of deducting the correct amount of PAYE and other statutory taxes, which we will see are health surcharge and national insurance scheme contributions, and we will get into that a little later on in the slides. We will also touch on the issue of VAT, value-added tax, because once a sole trader actually makes supplies or sales in excess of a threshold, which is currently 600,000 TT dollars in a 12-month period, and if you divide that over a 12-month period, it works out to $50,000 per month. So once your sales or your gross income exceed that amount, there is a basis to apply for VAT registration. So we will touch on some of the requirements to register for VAT and what are the consequences of registering for VAT, compliance-wise and otherwise. And we will round up this evening with a bit on property tax. And you may ask yourself, well, why property tax and how does it fit into what we are talking about on income tax. And I think property tax, the relevance of it is really as a result of the government's recent reintroduction of property tax, which is applicable in the first instance to residential property owners. As we speak on property tax, I will highlight for you the fact that property tax is not only applicable to residential property owners, but also extends to commercial, industrial, and agricultural properties. However, the focus of the government at this point is on the residential component. So we'll just touch a bit on that. And, to be honest, when you think about property tax, it also has a correlation to income tax. And we will touch on that, both from a deductibility perspective, as well as the impact of property tax on your ability to claim wear and tear allowance, which is tax depreciation in the case of sole traders. So before I move on to the next slide, I just want to briefly touch on the limitation to the left. This language is standard in all our presentations, and essentially what it is meant to say is that coming out of this session, you're not going to be an expert in tax, but hopefully you will have sufficient knowledge and information to be able to handle your tax affairs with purpose and with the correct approach that is needed in addressing that. I just want to make the point that Trinidad and Tobago finds itself in a very unique situation in that the economy is not in the best of states as we would like it to be. I think we are all aware that we have found ourselves in some deficit budget situations, deficit positions where our expenditure has exceeded our revenue. And basically, governments are challenged with how to manage expenditure and increase revenue collection in order to balance the books, so to speak. And Trinidad and Tobago would have done some studies in the past which concluded that there are billions of TT dollars left on the table annually through tax evasion. Essentially, there's a lot of money that is not being collected by the government, primarily through lack of enforcement, I would say. But in reality, this I could see as an area of focus going forward for the government. So what does that mean for us? It means as taxpayers and responsible citizens, we should really take our tax obligations seriously and account for our taxes when due. And the purpose of this seminar is really to help arm you with the knowledge and the information that you would need in order to get to that point and address your tax obligations. Please don't take it to mean that I'm suggesting in any way that anyone is non-compliant and not doing that currently, but I'm just highlighting for you that this is really an area of focus, and the Board of Inland Revenue, which is the current arm of the government responsible for collecting taxes, the intention is to actually transform that entity into Trinidad and Tobago Revenue Authority, under which both the existing BR and Customs and Excise would fall. And I think one of the major initiatives and focus areas of that entity would be on improved tax collection. So there would be more focus, I think, on compliance and enforcement. So let's look at this in a very serious manner going forward. So we're going to start with income tax obligations of a sole trader. And what exactly is a sole trader? So a sole trader is a self-employed individual who owns and often operates a business alone. So basically, we've seen individuals go into business in different forms. You have sole traders, which we are going to be focusing on today. You have partnerships. and then you have companies. We're going to touch on companies tomorrow, and we're going to spend some time looking at the similarities and differences between a sole trader and a company. What you will observe is that the manner in which the tax liability is computed for an individual sole trader and a company, they are quite similar in terms of the ability to claim deductions which are wholly and exclusively incurred in the production of income, the ability to claim certain allowances, such as wear and tear allowance. I did mention that at the beginning of the session, and other allowances granted under the Act. I will also make the point that in the case of partnerships, which unfortunately we will not be covering, and there's a very specific reason for that, partnerships in a tax context does not represent a taxable entity. A partnership actually is an entity which is formed by a number of persons or entities. And the partnership, where it is an unregistered partnership, actually it is used as a mechanism to report the income of the group, the partners to that partnership. But the partners, the individual partners to the partnership, are the ones who are responsible for accounting for their share of profit for income tax purposes. So the partnership itself is not taxable, but the individual partners to the partnership are taxable on their share from the partnership, as the case may be. Okay, so focusing on the individual tax, we did make the point as well that the owner has unlimited liability, meaning personal assets could be used or taken to cover business debts. And this really applies from a legal perspective. You know, when you look at the formation of a company, by its very name, a limited liability company means the liability is limited to the assets and the share capital of the company, so that the individuals and the company are treated as separate entities. In the case of a sole trader, of course, you are the main contracting party, so any legal consequences as a result of non-performance of duties would fall to you, the sole trader. And that is basically what we are mentioning here. Okay? So, in Trinidad and Tobago, sole traders have these specific tax obligations which must be adhered to. So from an income tax perspective, sole traders pay income tax on their chargeable profits. And the income tax rates in Trinidad currently are 25% on the first 1 million TT dollars of chargeable income and 30% on amounts in excess of the 1 million TT dollars. Individuals are also entitled to a personal allowance of $90,000 per annum, individuals who are resident in Trinidad. And this could be, of course, claimed by those persons who are resident and operate in Trinidad. Now, from a reporting standpoint, and this is covered in, I think, the extreme right, you would basically pay taxes on a quarterly basis, as opposed to a person who is employed, where the employer deducts the taxes under the PAYE regime on a monthly basis. So for sole traders, the first thing that you will note is that the taxes are actually due for reporting on the 31st of March, 30th of June, 30th of September, and the 31st of December, with any balance of taxes due by April 30th of the following year. Now, how do you compute your income tax quarterly installments? Well, for the purpose of the legislation, the Income Tax Act makes reference to using the chargeable profits or chargeable income rather of the prior year as the basis to compute your income tax quarterly installments for the current year. So in other words, you take your prior year's chargeable income. And your chargeable income is your income from all sources after deducting any expenses wholly and exclusively incurred in producing that income and allowances that are eligible for claim, wear and tear allowance and other allowances that I would have mentioned. And that net position is what we call the chargeable income. So it's basically a gross income after deducting expenses, allowances, and exemptions under the Act. And when you apply that income by the applicable tax rate, so if that chargeable income figure is below 1 million, you apply 25%. If it exceeds 1 million, then you apply 25% on that first million and 30% on anything over 1 million TT dollars. Okay, so basically you take that chargeable income, you multiply it by the current year's tax rate, and you divide it by 4 because it's 4 quarterly installments that are due for the year. And those quarterly installments then become payable March 31st, June 30th, September 30th, and December 31st. Now, you might be asking yourself, well, what if my income is less than the prior year? Do I still pay my quarterly installments on the prior year's chargeable profit? And the answer to that question is not necessarily, because the Income Tax Act actually has a provision that allows persons to write to the Board of Inland Revenue to request a reduction in quarterly tax installments where you expect your chargeable income for the current year to be less than that of the prior year. So in other words, if you, at the end of the second quarter, which is June 30th, realize that the business is not trending as positively or profitably as it was in the prior year, you do have the ability to write to the board to ask for a reduction or even a waiver of quarterly installments for the remaining 2 quarters, which will be 30th of September and 31st of December. Now, I will give you a heads up because we have done this for many of our clients. The Board of Inland Revenue currently do not provide responses to these letters, unfortunately. But we will encourage our clients and you taxpayers to still write to them because you want to have something on your file to show why you did not pay your quarterly installments in accordance with the prior year's chargeable profit, right? And that ought to act as a safeguard for you in guarding against any interest for short payments or late payments. Well, short payments actually of taxes in the first instance, right? So in addition to income tax, health surcharge is actually payable on a quarterly basis as well by sole traders. And health surcharge is really calculated at the rate of $8.25 per week. Now, from a quarterly basis, that equates to $107.25 per quarter. And split over 4 quarters, it equates to 429 TT dollars for the year. So you will have income tax and health surcharge ordinarily to pay on a quarterly basis. We will get to business levy on the next slide, but suffice it to say that business levy also has a quarterly reporting requirement, but it's not necessarily applicable in all instances. And we will go through the instances that business levy is applicable so that you can have clarity in order to determine how you deal with the business levy. Before I go to VAT, I want to touch a bit on the national insurance. So national insurance, contemplates mandatory contributions that provide benefits on sickness and maternity and so forth, right? Currently, sole traders do not have the ability to contribute under the NIS regime. So for you to fall within the NIS regime, you have to actually be employed by a company or an employer, as the case may be. Okay. So some other points to note before we move on from this slide. VAT is applicable to sole traders whose commercial supplies exceed the threshold of 600,000 TT dollars in a 12-month period. And what is a commercial supply? So a commercial supply is a supply of goods or services in the course of or furtherance of your business. So basically it's what you produce or sell would constitute your commercial supplies. And of course, we are talking here gross income, not net profit. So once your gross income exceeds 600,000 or $50,000 per month, then you would have an obligation to register for VAT. Now, once you are VAT registered, you are allowed to recover your input VAT incurred in generating commercial supplies. And, you will file VAT returns periodically every 2 months and so forth. I think we will get in a bit more on the VAT a little later on, but it's important to note that once your sales are trending above a certain threshold, you should consider VAT registration, provided that the nature of your supplies qualify for VAT. So there are certain supplies for VAT which are exempt and which are zero-rated. Zero-rated supplies fall within commercial supplies, thereby making you eligible for VAT registration. The only difference is that once your supplies are zero-rated, it means you charge VAT at 0%, as the name suggests, zero-rated supplies. But if you make exempt supplies, so for example, bus and taxi services are exempt for VAT. Real estate brokerage, training and education, financial services, these are all exempt for VAT. So if you fall within those specific types of services, then you will not have a basis to register for VAT. In addition to which, the VAT Act specifies certain types of supplies which do not constitute commercial supplies. So, for example, if you were to sell a building or land, that does not constitute a commercial supply for VAT purposes, and therefore it takes you out of the VAT regime, thereby making you not eligible to register for VAT for that type of activity. So there are little nuances on the VAT side which we could touch on, and determine whether VAT registration is necessary in these circumstances. So record keeping, that is very important. And why is that important? That is important because you would, for tax purposes, our tax authorities place a lot of emphasis on documentation in audits. And what you would want to ensure is that whatever you declare for income tax purposes by way of income and expenses, it is matched or supported by invoices, contracts, purchase orders, etc. Once you have your documents aligned to your income tax filing, then you should be in a very good position for the purpose of defending any assessments that may be raised in an audit. But generally speaking, in Trinidad and Tobago, the statute of limitations is really 6 years from the end of the year of income, or 3 years from the date you file your tax return, whichever is later. So the requirement to maintain your books and records would generally be that 6-year period. Okay. And we are looking at tax deductions just to round up this slide before we move on. I did mention the whole issue of chargeable income being a net position, where you take your gross income less any allowances and deductions and so forth. An individual who's a sole trader is allowed to deduct expenses which are wholly and exclusively incurred in the production of income. Wholly really refers to the quantum of the expenses, while exclusively refers to the fact that there ought to be no duality of purpose in the spend. So in other words, if you incur an expense, and a lot of you may have this situation that has both a private and business element, you could see there being a duality of purpose. And whilst the Income Tax Act does not provide specific proration percentages for expenses that have dual purposes, the accepted practice for filing of tax returns would be to prorate the expenses in such a way where 2/3 of the expense is deducted for business purposes and 1/3 is treated as personal. And common examples of these include if you run your business from your home, you would have electricity. You may be paying a rent or a mortgage. You would have water expenses, maintenance costs, repairs of air conditioning units possibly. And these are costs that all aid you in being able to run your business. But admittedly, they also have a private element to them, a private benefit to them, which is why our position on matters of that nature would be to not claim the expenses that have that duality of purpose in their entirety, but rather to prorate the expenses for the purpose of computing your income tax liability. Okay? So I'm just going to go to the next slide. I hope everything there is clear as it relates to...
And
Mr.
Colin, as before you go on to the other slide, I have been seeing some questions coming into the chat. So I am going to ask Mr. Williams if he can kindly read those questions one by one, and then we will give the answers accordingly.
Yes, good night. So we have Miss Diana. She's asking if this evening's session is going to be shared. And that's the first question.
Right. So Diana, good question. We will certainly provide the slide deck to Mark and the team at Western Credit Union. A lot of what I'm saying here is stuff that I am speaking to from off the top of my head and experience, but we could certainly, in the attachment to the email with the slides, drop in any additional information that may be useful to you, the members, that I would have touched on during the session.
And what we are going to do as well, Colin, we are going to make, because I saw that someone asked on the earlies, if the presentation or the entire webinar, both day 1 and day 2, will be made available. Yes, as is customary, the webinars will be made available on our website and throughout all our social media platforms. So it will be made available there. And in addition to that, what we are going to do, we are also going to make the slides available on our website as well. And we are going to make it that in such a way that you can download it and file it away if you so desire.
Perfect.
Aaron, go ahead, please.
The second question we have is from Miss Diane. The second question we have is from Miss Jackie. Can companies request a waiver as well? And I believe that pertains to the value-added tax.
Can you repeat the question? Can companies
request a waiver as well?
A waiver of VAT or of penalties and interest? Oh, all right. So if I understand Miss Jackie's question properly, when I spoke to waiver, I spoke to it in the context of quarterly installment reporting. So if you just to go back a minute, I spoke to quarterly installments being determined based on your prior year's chargeable income or chargeable profit. But if your chargeable income or profit is lower than the prior year, then you could write to the Board of Inland Revenue for approval to pay a reduced quarterly installment or a waiver of the requirement to pay quarterly installments for the remainder of the tax year, right? So the answer to that question is yes. As we will cover tomorrow for companies, you will note that the reporting for tax purposes for companies is very similar to the individual tax. And the other point I will make is when you look at the construct of our tax legislation in Trinidad, the Corporation Tax Act, Section 19, incorporates several sections of the Income Tax Act, so that a lot of what we discussed today, by way of principle, would equally apply to tomorrow's session. So we could spend a little less time going through some of these principles because we would have touched on them in sufficient detail today. I hope that addresses Ms. Jackie's question.
And the third question we have, how are expenses such as market produce recorded when receipts are not given?
That is a very good question. I would say in situations like that, you would have an agreed expense basis with your supplier. And if possible, I don't know if some type of receipt could be issued as an acknowledgement of the payment you make, because presumably there would be some arrangement where cash is passed in exchange for the produce that you receive. That would ideally be the best scenario where no invoice or anything like that is issued. Other than that, I think it would be a matter of you taking note specifically of the quantities purchased, the date purchased, and the amounts paid. I will also make the point to the person who asked about the market produce that there are actually special tax provisions for persons in agriculture. We have not included them in these slides, but certainly something we could look at separately, because there are tax exemptions actually for approved agricultural holdings under the Income Tax Act.
And the next question we have is from Ms. Johnson. What if you are a sole trader business that does not make 90,000? How do you pay taxes?
Okay, good. That is a very, very good question. So you're not making 90,000 chargeable income, which means you are below the personal allowance. It means you will not be subject to income tax because your chargeable income is de facto zero. It is wiped out as a result of the personal allowance. In that case, you pay health surcharge of $107.25 per quarter, equating to $429 for the year. And you also pay business levy where due. right? And I'll just switch quickly to business levy to give you an understanding of how business levy works. When you read the Income Tax Act, Section 5E, it says for each year of income, there shall be levied and paid to the board at a rate of 0.6%, a tax to be known as business levy on the gross sales or receipts other than emolument income under Section 100 of a person. So essentially, if you are self-employed or sole trader, the business levies on your gross income. Now, what is important to note is in subsection 1, which we just read, does not apply in these cases. Gross sales or receipts, which give rise to income tax, which is exempt under any act. It does not apply to persons who earn emolument income under Section 100. And what is emolument income? Emolument income broadly is defined as income from employment. It does not apply to the gross sales or receipts of a person where in the preceding year and the current year, your gross income is less than $360,000 for the year. So this is why I said this is very important, because if your gross income falls below $360,000 annually, then, and that is for the current year, as well as the prior year, then you are not required to pay business levy. And then where your gross sales or receipts are within the first 3 years of commencement of business. Now, it's interesting, tax is such a beautiful field, right? For companies, the 3-year exemption starts from the date of incorporation. For sole traders or individuals, the 3-year exemption starts from the time of commencement of business. So you see there being a difference already. And when we come to companies tomorrow, we'll touch on that and make that distinction once again. So to answer Ms. Johnson's question, what are you required to pay where your chargeable income is below the $90,000 personal allowance? No income tax. You pay health surcharge quarterly. You pay business levy only where it is applicable. And it will only be applicable if you are outside of that 3-year period from commencement of your business or your gross receipts or income exceed the threshold of $360,000 in the current year and was the same in the preceding year of income.
Thank you. And we have another question from CM Productions. What are some other VAT exemptions if you are meeting the VAT threshold, but your service is not VATable?
I think we
Thank
need
you
to.
very much, and Colin. This is going to be the last question that we are going to be fielding from the Q&A section.
Sure, no problem. And I welcome the questions. It really shows me people are tuned in, and I like that. I mean, it really makes it more, I think, informative. So to answer the question, we'll have to look at it further because, the VAT Act has very prescribed rules around commercial supplies. And services generally are VATable, except for those that I mentioned, like real estate brokerage and residential services and so forth. Real estate brokerage and financial services, training and education, and so forth. Now, interestingly, you may have a situation where you supply both exempt and standard rated or zero rated supplies. So we see it a lot with financial institutions. When we think about it, a bank would provide financial services, meaning they borrow, they lend money, and they take deposits and so forth, which will not be subject to VAT, that is exempt. But they may lease vehicles or lease property, commercial property, which is actually VATable. And what happens, the VAT Act actually is very specific in that instance. It says where your input VAT relates to the generation of commercial supplies that are exempt, you get no recovery of that input VAT. Where the input VAT relates to the recovery of expenses in the production of your standard rated or zero rated commercial supplies, you get to recover all of that input VAT. However, where the input VAT relates to the production of both zero rated and exempt supplies, you prorate the input VAT by taking the standard rated supplies over your total supplies by the input VAT in question. And a prime example of that may be electricity or rent. A bank may rent a building and pay electricity in that building, but conduct both banking business and leasing business from that building. So you can't say that the electricity is all for the banking and all for leasing. So what you do is you prorate, as the case may be, for the purpose of determining what is the eligible input VAT to be recovered. I hope that addresses that question. All right. So,
Professor, continue.
Okay, no problem. And you know, keep the questions rolling. We do have time, hopefully, at the end of the session where we could spend some time discussing any unresolved questions going forward. So, as I mentioned, business levy is like a minimum tax. And a company would pay business levy where, you know, you take the gross income or gross sales of the sole trader and multiply 0.6%. Business levy is also payable on a quarterly basis, and the quarters are 31st of March, 30th of June, 30th of September, and 31st of December. Of course, where there is a balance of business levy due, you pay it by April 30th of the following year. Now, I'm going to get a bit technical here, but suffice it to say that when you are estimating your business levy, you basically take the rate by the gross income. Now, because the business levy is due for payment the last day of the quarter in question, one would appreciate that there's some element of estimation in the calculation, because March 31st would cover the quarter January 1 to March 31. And you may not have all the available data for your sales up to and including March 31st at the point in time. The law actually says for business levy that you should pay a minimum of 90% of what the actual business levy due would have been on your gross receipts. So try as best as possible to estimate with a degree of accuracy the business levy that is due, because the law allows for no interest on short payments to be charged where you meet that 90% threshold. And of course, the 10% shortfall, you roll forward and you include it in the next quarter's business levy. So when you go to April to June, you take 90% of what it should, the actual should be, and you add the 10% shortfall from the previous quarter, and then you take 0.6% of that, and you pay that, and so forth. Now, the law provides for interest on short payments at 15% per annum. In practice, the Board of Inland Revenue imposes the interest at 20% per annum, which is wrong, but that is how the system is configured, unfortunately. Now, where do you see this interest? It shows up on a notice of assessment. So when you file your tax return, which is really due for filing by April 30th of the following year, so I would have mentioned you pay your quarterlies March, June, September, December. By April 30th of the following year, you file your individual tax return as a sole trader. You disclose whatever quarterly receipts were paid in support of your income tax liability. You declare your health surcharge paid, etc. If there's a balance of tax to be paid, it's done by April 30th. And it's the same thing for business levy. If there's any balance to be remitted, it's dealt with by the April 30th deadline. But I believe we would touch on that a little later on as far as the filing of the returns go. Okay. So again, these are just some really key takeaways. We would have spent a lot of time talking about this, but I don't think it really is sufficiently dealt with. So the business levy applies to businesses whose gross sales or receipts exceed that should actually be $360,000 in a financial year. So please accept my apologies. We will update the slide before we send it. So the threshold is actually $360,000 for a 12-month period. That $500,000 is actually what the VAT registration threshold was before it increased to $600,000. And in the past, business levy and that threshold moved in line with VAT. So I think that was what accounted for the confusion on this slide. So my apologies once again. The rate is 0.6% of the gross sales or receipts that are applicable. As again, the filing and payment, sole traders remit business levy on a quarterly basis, and the quarterlies are due March, June, September, and December, with any balance due by April 30th of the following year. And of course, record keeping is important, as I mentioned, to safeguard in the event of an audit by the tax authorities. You want to ensure that, look, whatever you disclose for income tax purposes is supportable and defendable. And I just want to make the point that, Trinidad has a self-disclosure filing system. So basically, you disclose what you consider is your correct chargeable income. The Board of Inland Revenue then has 6 years to audit you, or 3 years from the date you file your tax return, which is why we mentioned the 6-year period for retention of books and records, because that is what we call in the tax world the statute of limitations. 6 years from the end of the year of income, or 3 years from the date you file your tax return, whichever is later. And that's why it's important to retain your books and records, so to defend any assessments that may be raised in an audit. So at the end of the day, I think from the exemption standpoint, we did cover quite a few. And just to reiterate the important ones, where you are within the first 3 years from the commencement of your business, you are not subject to business levy. Also, where your gross income is less than $360,000 in the current year and the preceding year, you are not required to account for business levy. Okay? And then, of course, what are the funds used for? Well, the funds are generated from the business levy are used by the government to fund various public services and initiatives. Okay?
Colin, at the top of the hour, if I may interject, we are going to a commercial break. But I just want to insert 2 questions.
Sure.
One from Ms. Sabrina Samuel, and the other from Ms. Michelle Williams. And Ms. Samuel is asking the question, if a sole trader has 2 employees, does the business pay health surcharge for both employees as well as the business? Or you pay health surcharge on the employee's individual BRR number? Also, what is the purpose of health surcharge?
Those are very good questions. And to answer the first question, if you have 2 employees, you become their employer. When you look at the definition of what an employer is a person from whom an employee receives his or her remuneration. And that makes you now responsible for accounting for statutory taxes that are due for those employees that work for you. And as we're going to cover in the session ahead, the statutory taxes are PAYE, health surcharge, and NIS. So yes, you are required to account for health surcharge at the rate of $8.25 per week. Now, I'm not sure how you would pay them, but the actual, whether it's weekly, fortnightly, monthly, but the health surcharge and any NIS that is deducted would normally be remitted by the 15th day of the month following that in which you deducted the health surcharge and NIS from their salaries. Now, the NIS is a bit tricky because I did mention self-employed persons are not allowed to contribute under the NIS regime currently. So it is uncertain, and something I would investigate whether you could secure employer registration as a sole trader for NIS purposes. That's something I will discuss internally and perhaps provide some feedback to Mark, who could then feed it back into you as the case may be. And the purpose of health surcharge, I think, is actually really geared toward helping with the health system. I mean, upkeep of the hospitals and the medical facilities. That is my understanding of what the funds from health surcharge are used toward.
Thank you very much, Colin, for answering those questions. Those two questions. And then Ms. Williams was asking, when you send a letter to the BIR, what proof that I have that they receive the letter if they don't respond to the letter in waiving of the income tax?
Excellent question. So what we would do, Ms. Williams, is we would typically send two copies, well, an original and a copy of the letter, hand delivered to the Board of Illinois. And we would normally request that a clerk at the board stamp the copy using the BIR stamp for receiving it. Now, my understanding is the practice varies at the Board of Inland Revenue. Some officers are inclined to stamp the letters, others may not be as inclined to stamp the letter. But if you could request that they at least initial the letter for receiving it and dating it, at least you will have something on your file to show, well, that you dropped it off and this person initialed and dated it for receiving it. The ideal would be a stamp from the BIR to keep on file. Other than that, sadly, there would be no other proof of you submitting the letter. Now, I will say to everyone on this call that the Board of Inland Revenue and filing of tax returns are now done electronically. So there's now an e-tax platform, and it's not now, it has been a few years in existence, that you file tax returns and you have both a logged in and a non-logged in approach. Now, under the logged-in approach, you are required to get a TT Connect ID to be able to log into your own individual account for e-tax purposes. When you log in to your e-tax account, you basically get a snapshot of all your various taxes that your BIR number are associated with, whether it's health surcharge, income tax in the form of PAYE, and so forth. So the reason I'm making this point is any correspondence you filed with the board should file its way onto your profile for e-tax purposes. So it may be worthwhile, actually, to consider registering for e-tax to access the profile through the logged-in approach going forward.
So at least you will have an email trail of you submitting the letter to the Board of Inland Revenue. Yeah.
But so when you log in, you actually have different tabs on the e-tax system, and you could actually pull up correspondence. You could actually pull up notices of assessment, tax refunds that are due, letters. So everything should be there. That should be a form of proof that you submitted the letter as well, feeling the duplicate copy being signed and or initialed by a clerk or officer at the Board of Inland Revenue.
Well, thank you so very much, Colin, for answering those questions. And ladies and gentlemen, as you can see, as promised, it is a very lively and informative session this evening. So we are going to a commercial break and we'll be right back.
A friend introduced me to the credit union. A friend told me to go and join. I was a young girl, having 2 children, really in turmoil, in real turmoil. And I had a business. And it had times where the business was down. And I went to the credit union and I talked to them and they tell me, bring all your bills and we'll help you. They have a lot of things they help me with. Because when my son got in trouble, they were there for me, they helped me. Sometimes I leave home, I know my next meal coming from and I walk straight into the credit union and they were there. They were there for me. The credit union has been good to me. Have me standing on my feet. I can't go hungry with the credit union, with that Western United Credit Union. I will invite anybody to join the credit union because they know what they're doing there.
In calculating your property tax, how it is done, how it is done over the period of time.
There are various categories of properties which attract different rates. For residential purposes, the rate is now 2%. For commercial, the rate is 5%. Industrial, the rate is 6%. But plant and machinery not stored or housed in a building or structure, the rate is 3%. And for agricultural property, the rate is 1%. In computing property tax, it is levied on the annual rental value, the rent which one expects to get from the property. There is a provision that allows for a 10% reduction from that annual rental value. The example, to take a rental value of $5,000 per month and extrapolate that over a 12-month period, which gives me $60,000 in rent annually. I then apply that 10% discount factor, which reduces that $60,000 to $54,000. That is the basis on which that 2% rate is applied. When I apply 2% against the $54,000, resulted in $1,080 annually in property tax.
How am I going to meet this yearly obligation in a very affordable, organized manner? How much do I have to pay on a monthly basis?
When I did the calculation, that figure resulted in $1,080 annually in property tax. And that is what you will have to pay for a property that is rented for $5,000 a month. If you were to take that $1,080 and spread it over a 12-month period, as Mark would have been suggesting, in order to reduce the burden, as a matter of being prudent, one may put aside money on a monthly basis. That $1,080 spread over 12 months, provided my math is correct, is $90 per month.
And that is one way that we can address it and not having it feel so burdensome.
So what do we mean when we talk about feeling forward as opposed to feeling backward as an entrepreneur?
The book Feeling Forward. So it said the more you do, the more you fail. Mm-hmm. The more you fail, the more you learn. Mm-hmm. The more you learn, the better you get. Mm-hmm. Determining what went wrong in a situation has value. But taking that analysis another step further and how you use it to your benefits is a real difference maker when it comes to feeling forward.
What do you have to say to our entrepreneurs before we ring off?
Knowing where you are financially is extremely important, and is the reason why bookkeeping is important. So bookkeeping is going to tell you where you are, because once you know where you are, then you know the steps you need to take to get to where you want to go. The financial decision that you make 5 years ago determine the financial position that you're in now. And the financial decision that you will make today will determine the financial position you will be in 5 years from now.
So, Colin, we are going to get right back into it. And before we get back into your presentation, I just want to read 2 more questions. And Aaron, I'm not stealing your job. No, I am just looking at the chat here, and I'm seeing that Ms. Abigail Durant, and she's asking, what if your business was registered long before you actually started the business? How or from which point is the business levy calculated?
Yeah, but that's a very good question, Ms. Duran. As I mentioned, the timing for business levy to be applicable differs between sole traders and companies. So in the case of a company, the 3-year exemption commences from the date of incorporation or registration. In the case of a sole trader, it commences from the time of commencement of your business. So depending on how your business is structured, if you are operating under a trading name, a business name, as a sole trader with your individual BIR number, then that 3-year exemption starts from the time you started trading, irrespective of when your business name was registered. If, however, you operate under company status, unfortunately, that 3-year period would have sailed post the date of incorporation once that 3-year period lapses.
I hope that answers your question, Ms. Durant, and we'll just take one more question from M. Alexander, and this is a very brief question. The question is, are fees and charges payable online?
So that's a very good question. Recently, with the reintroduction of property tax, we have seen the government take steps to ease the burden on the tax-paying public, driven by long lines and, getting the property tax paid through the introduction of online payments. Now, my understanding is that this is unique and specific to property tax at this point in time. Unfortunately, where you have other forms of taxes to be paid, there are wire transfer facilities that allow for that, but not online payment facilities at the current moment. The online wire transfer facilities, moreover, is really meant for foreign taxpayers, from what I've seen, like non-resident entities remitting taxes through that wire transfer mechanism. So that really, in the case of a sole trader or company, the traditional form of going down to the Board of Inland Revenue and remitting the taxes through a check or cash remain the options available. My understanding is they also accept payments by bank card as well at the cashier's unit. So that's also a possibility. But the online, unfortunately, still has to be revamped.
Okay, thank you very much, Colin. And if I may just slip in one more from Ms. Shamila Mohammed, and she's asking, she said, good evening. What are the penalties involved for sole trader not registering for VAT? Additionally, if a sole trader should have registered for VAT, that is a year ago, what steps should be taken now apart from registering, can an arrangements be made with the BIR to update the VAT records?
Yes, so that's a very interesting question. I mean, I'm actually doing this webinar from my office. So I do actually have the benefit of my legislation in front of me. And what it's saying, what the law says in section 20, which deals with VAT registration, is a person who, not being registered, makes a commercial supply by reason of which he's required to be registered, commits an offense, and is liable on summary conviction to a fine of $15,000 and imprisonment for 1 year. So basically, if you are required to register for VAT and you fail to, the fine on summary conviction is 15,000, 1.5, and imprisonment for 1 year. Now, what have we seen in practice? Well, look, if you were supposed to register for VAT and you didn't, now is the time to do so. And you might ask yourself, well, how do I go about doing it? I think you will fill out the application, and then you go into the Board of Inland Revenue, provide an explanation as to what transpired over the preceding period, and basically you're coming with open hands to get registered now and disclose the requirements for that registration. Now, the issue, apart from the fine, is the board actually could treat you as though you were VAT registered from the time you were supposed to be VAT registered and charge you VAT. We've seen them do it in few instances, but we've seen them do it before. In the case of a sole trader, I'm not sure they will take that much of a aggressive approach. We've seen them do it for companies in particular, where they said under section 20, there's a subsection under that provision that allows them to treat you as if you were VAT registered from that period they thought you should be VAT registered, and then charge you VAT along with penalty and interest. And for VAT purposes, the penalty is 8%, and interest is levied at 2% per month on the liability. So that equates to 24% per annum. Okay. So so my advice is perhaps consider dealing with the VAT registration, going on a prospective basis as quickly as possible. There is also an amnesty. I didn't mention this, but there's currently a tax amnesty which waives all penalty and interest for VAT, corporation tax, income tax, withholding tax, various taxes, up to and including income year 2023 and prior, where these taxes are paid on or before 31st of March 2025. So an option to consider is actually going to the board with the application, and if there is any assessment done or any requirement to pay VAT for any preceding period, you have the amnesty that could waive all the penalty and interest once it's done between now and 31st of March 2025.
Thank you very much, Colin. And I am seeing that M. Alexander is saying thank you for your response, and you are most welcome. But Colin, I remember when I registered my business and I was going through the entire processes, and I went to register for VAT, and they asked me, well, new company, and they told me I do not have to register for VAT because I did not meet the threshold for paying VAT.
Right.
Yes. So
So
is it that you register for VAT based on the amount of monies that you would be making in the year? And if you are not making that threshold, then there's no need to register to pay VAT?
Mark, that is an excellent question. And quite frankly, it is a situation that we are battling with internally at the moment for a client of ours. The VAT Act prescribes that where you expect commercial supplies to exceed $600,000, which is the threshold in a 12-month period, you are required to register for VAT. Not when the 600,000 is exceeded, but now. And to do that, you would normally provide a contract to show that the value of supplies that you will be making will exceed the threshold, and or an agreement, for example, an agreement for lease of property, which would show a value that you incur above a certain amount, which would imply your intent to trade, and of course, with a profit motive in mind, make money in excess of that. So to answer your question, technically, you apply for VAT registration from the time you expect your business to exceed the threshold. In practice, we have seen the board push back and say, well, no, we want you to start trading first and make supplies, bring your paperwork in so trade for 2 months, 3 months, come back after that period, show me what your sales look like, and then we will do an extrapolation and see if you're going to exceed the 600,000. I think they're a lot more cautious around registering persons for VAT. And the reason for that is, unfortunately, they've been burnt in the past by unscrupulous business people who registered for VAT under false pretense. So they would have put forward the position that, look, I'm going to register for VAT, claimed input VAT, got their refunds, and then apply for VAT deregistration because they just never went ahead and traded. I mean, this is based on information that I was given in speaking to officers at the tax authority, right? And so I think as a means to safeguard themselves, they are much more careful in how and when they grant VAT registration certificates. And so they scrutinize the applications carefully, and they will not accept it unless they are satisfied that the proof you provide gives them the comfort that you will be exceeding the threshold in the next 12 months.
Thank you very much for answering that question, Colin.
No problem, Mark.
I will now turn it back over to you to continue with the presentation.
You're most welcome, no problem. So I will just share my screen again. Sorry. You can let me know, is it up?
Yes, I'm seeing it. I hope everyone else is.
Okay, good. So we on to payroll taxes. So we just completed and wrapped up the self-employed. Just to recap, self-employed persons account for taxes on a quarterly basis. The quarters are March, June, September, December, the last day of each of those months. Any balances are due to be paid by April 30th at the time you generally file your tax return. Now, I didn't mention this, but just to make the point that under the tax legislation, you actually have an automatic extension to file your tax return to 31st of October. And failure to file the return by that date for an individual leads to a late filing penalty of $100 for every 6-month period or part thereof the return remains outstanding, right? So basically, you have until October of the following year to file your return, but until April 30th to pay any balance of taxes due. And as a self-employed person, you deduct expenses wholly and exclusively incurred in production of income in calculating your chargeable income subject to income tax. You determine your quarterly installments using your prior year's chargeable income, and you are allowed to write to the board to request a reduction or waiver where your current year's income is less than your prior year. Now, I would also make the point that if the reverse occurs, meaning your chargeable income for the current year is more than the prior year, you are required to actually pay 80% of the increase in the current year over the prior year by December 31st. That was something I should have mentioned before the break when we were dealing with the quarterly installments. I was really focused on the reduction scenario, particularly because I want to ensure that persons, as much as possible, do the responsible thing to avoid overpaying taxes. But in the case of where your chargeable income is more than the prior year, just to repeat, you pay 80% of the increase in the current year over the prior year by December 31st, and then the remaining 20% is paid by April when you file the return in the subsequent year. Okay? And for individuals, sole traders who, making above the threshold for business levy, $360,000, business levy would need to be accounted for as well at the quarterly, on a quarterly basis, March, June, September, December. A company generally pays as well the higher of income tax and business levy. You would typically not be subject to both, but business levy is applicable only in the circumstances I mentioned to you. So in essence, a sole trader would take into consideration as an individual higher of income tax or business levy, and they will account for the health surcharge of 107.25 per quarter. Okay, so going to payroll taxes now, these are situations where you are employed by a company and you receive a salary. And in that situation, the employer has the responsibility for withholding the relevant tax under the pay-as-you-earn regime and remitting that tax to the Board of Inland Revenue by the 15th day of the month following that in which the emoluments were paid. So, in essence, your salary for the month of February, the PAYE would have been due for remittance by 15th of March, 2025. And similarly, your salary for March, the PAYE is due to be remitted by the 15th of April, 2025, and so forth. Now, similar to computing the income tax liability for the sole trader, individuals who are resident are entitled to this personal allowance of $90,000. So that's why we're saying the first $90,000 attracts no tax. Okay, but over the $90,000 and capped at $1 million chargeable income, you pay tax at 25%, and anything over that is at 30%. Now, outside of the income tax, we also have the health surcharge and NIS, which is accounted for on the payroll taxes. And the health surcharge is really levied at the $8.25 per week. So that typically equates to $33 per month. And then national insurance is done on a scaled base, depending on the salary band of the person. And for NIS purposes, the employer contributes twice that of the employee. Now, let me make an important point that individuals who are employees are allowed to deduct expenses wholly, exclusively, and necessarily incurred in generating the chargeable income, which include travel-related expenses and the like. But one would appreciate that there's a significantly reduced scope in deductibility for an individual who has an employee versus a self-employed person. If we go back to the sole trader scenario, we did indicate that an individual who's a sole trader could deduct expenses wholly and exclusively incurred in producing income. And that would allow them to deduct typical run-of-the-mill expenses, electricity, rent, maintenance, transportation, the various expenses one may incur depending on their line of business. And of course, we did make the point that where there's duality of purpose, there should be a prorated approach applied in deducting the expense. In other words, not all of the expense should be deducted if you're operating out of your residential home where you derive some personal benefit and so forth. For an individual who is an employee, the requirement is that you're allowed to deduct expenses wholly, exclusively, and necessarily incurred. That word necessarily puts an additional requirement to meet the deductibility criteria under the Income Tax Act, so that the scope of deductions available for employees are a lot more limited than self-employed persons. So employees would be entitled to the personal allowance of $90,000, but employees ought not to deduct electricity expenses, travel and transportation costs, unless they are traveling officers of the business and are so certified by the company and so forth. But other general run-of-the-mill expenses are limited in terms of what the employee could deduct. Okay, I hope that is clear. And in addition to the $90,000 personal allowance, there are allowances under the Act that individuals could claim. And, what we will do is we will attach a tax card, which is actually included in our budget presentation, which I think is quite useful because it summarizes tax rates and allowances that could be used as a reference point where, you may need to draw quick reference to what the rates are or the allowances are. And in the case of an employee, 70% of NIS contributions made by the employee are deductible in computing the income tax liability for the employee. Now, individuals who are employees are also allowed to deduct contributions to approved pension plans and deferred annuity plans, BR approved plans, capped at $60,000. It was recently increased from $50,000. So basically, the 70% NIS deduction for the employees' contributions, together with the contributions under the BR approved plan and deferred annuity plans, are capped at this $60,000 limit. And then there are other allowances for like tertiary education at approved institutions, which are extra-regional. There are allowances for first-time homeowners and so forth. So there are quite a range of allowances. And as I mentioned, we will submit, in addition to these slides, a tax card, which will have basically a summary of these allowances that could be claimed along with the particular rates, okay? So from a payroll perspective, let us bear in mind that the statutory payroll taxes are already PAYE, health surcharge, and NIS. They are all accounted for on a monthly basis, and the responsibility to remit those taxes rests with the employer and not the employee. The employer is further reminded that those taxes are due to be remitted by the 15th day of the month following that in which the emoluments were paid to the employee, failing which there would be penalties and interest. Okay? And just to remind those who were listening earlier that the tax amnesty does not cover income years 2024 and 25, so that if any payroll taxes are remitted late in the current year, those penalties and interest become due and payable. Okay? They're not covered by the amnesty, which really pertains to income years 2023 and prior. All right. So at the end of the year, the employer is required to issue a TD4 supplementary form to the employees and prepare a TD4 summary form, which it would basically use for filing purposes with the Board of Inland Revenue. And that TD4 supplementary form is what individuals who are employed use to file tax returns if they so choose. Now, under the Income Tax Act, individuals who are in receipt of emolument income only, which means income from employment, are not required or obligated to file tax returns in Trinidad and Tobago. Let me repeat that. Individuals who are in receipt of emolument income only are not obligated to file individual tax returns in Trinidad. If, however, you have other sources of income, be it income from a trade or business, or rental income, as the case may be, and so forth, then the obligation to file a tax return would be created. Now, I would tell you, personally, I have assisted many people from my alma mater who have gone on to work in public sector and different lines of business with their individual tax returns. And I would say, and this is no knock against the government, but for many of my peers and colleagues who work in the public sector who have assisted with their individual tax returns, who are generally emolument income earners, and I will not specifically call the public service areas that they are employed in, but I have found that they have been overtaxed, and I've actually helped them file their tax returns and recover tax refunds in the process. Just food for thought, people may be of the view that, well, I don't have to file a tax return because my employer deducted the right amount of tax for me. So I will put that to bed. But, it may be useful to take your TD4, which is what your employer should issue to you by February the 20th of the following year, to file your tax return if you so choose. And it may be good to do a back of the envelope calculation, so to speak, to see if you've been overtaxed. And if you have been, file your tax return and claim the refund that is rightfully due to you in these circumstances. Yeah. Okay, so we just wanted to give a high-level example of benefits in kind. Now, benefits in kind is a term used to describe where expenses are incurred by an employer to the benefit of an employee. So much of the expenses that are not made good by the employee to the employer constitute a benefit in kind, and a benefit in kind is taxable under the Income Tax Act of Trinidad. Now, so generally, when a company incurs an expense on behalf of a director or employee, and the director or employee does not make good on the expense, reimburse the company for the expense, as the case may be, that could constitute a benefit in kind. Now, for motor vehicles, for example, if a company provides a leased motor vehicle to an employee, the benefit in kind changed post January 1, 2006. So prior to January 1, 2006, the lease vehicle would have attracted a benefit in kind equivalent to 33.33% of the monthly lease payment. But in current times, because we are no longer dealing with that time frame, that is almost 20 years ago, the benefit in kind is now 50% of the lease payment on the vehicle. Now, if the company owns the vehicle, the benefit in kind is equivalent to 50% of the capital allowances on the vehicle, the wear and tear allowance. So just so that you know, and this is for everyone's education, wear and tear allowance is an allowance that sole traders and companies are entitled to claim in respect of assets that are owned and used in the trade or business. So a motor vehicle, a computer, furniture, plant and equipment, machinery, fixtures and fittings, capital improvements to building or structure, all of these expenditure constitute capital expenditure. And for tax purposes, to deduct that expense, it must be revenue in nature and not capital in nature. And it must be wholly and exclusively incurred in the production of income. Now, for capital type expenditure, the Act allows you to not deduct that expense in one shot, but rather to include that capital expenditure into a wear and tear pool, which consists of different classes. So you have a class A, which covers buildings and so forth, that attracts a wear and tear of 10%. And as I mentioned, the tax card summary will have all of this information. So don't worry about not picking up on the particular rates. It will all be captured in the tax card summary that we will send following the session. The Class B assets generally comprise of motor vehicles, plant and equipment, machinery, and that attracts a wear and tear rate of 30%. Class C generally consists of heavy equipment such as bulldozers, forklifts, and computers actually, and that attracts a rate of 33.3%. And then Class D, second-hand aircraft, which attracts a rate of 40%. What I will say is motor vehicles fall in Class B. So if a motor vehicle is owned by a company and provided to an employee for his private and business use, then the benefit in kind accessible to that employee would be 50% of the wear and tear that the company would ordinarily claim on that vehicle. So Class B, as I mentioned, attracts a wear and tear rate of 30%. If the vehicle costs $100, you put it into the wear and tear pool, wear and tear of 30%, which equates to $30, is claimed on that vehicle. And then the benefit in kind is now equal to 50% of that wear and tear. So 50% of that 30, which equates to $15, is now your benefit in kind, which is spread over the year to determine the PAYE due on that BIK. I hope that is clear. So we have some cases where housing is provided or accommodation, as the case may be. The taxable benefit in that case is the fair rental value for the property where the property is rented, and where the property is owned. Essentially, it would be equivalent to the fair market value as well for the property. So where it's rented is what is the rent you pay, and where it's owned is like the equivalent of the fair rental value. And then we mentioned things like laundry allowance, but this really is broader than laundry allowance. It's really any allowance, any cash allowance, because sometimes an employee may be given an allowance for meals or different types of allowances in cash or otherwise. The benefit in kind is really the cost incurred by the company on behalf of the employee. So in addition to your basic salary, where you're in a position in an organization to earn perquisites from your job in the form of benefits in kind, the provision of a cell phone, motor vehicle, laptop, accommodation, and so forth. And then these benefits in kind need to be taken care of. So from an employee statutory tax perspective, we would have done this, but there's no harm in just reiterating. the statutory payroll taxes, as I mentioned, are PAYE, health surcharge, and NIS. And health surcharge applies to individuals who fall within the ages of 16 and over and under 60 years. And the amount is $8.25 per week. It actually equates to $33 per month, generally speaking, and $429 per annum, right? National insurance contributions are based on scale rates. Again, the tax card in the budget document that we will share would include the NIS rates. It's based on salary bands of the individual and the percentages apply. Just to reiterate that the employer contributes 2 times that of the employee for NIS purposes. And in computing the chargeable income of the employee, the deductions are limited to those costs that are wholly, exclusively, and necessarily incurred in the production of income, which limits the deductibility scope for the employee. So the employee can deduct the personal allowance once he's resident in Trinidad, $90,000. He's entitled to 70% of the NIS contributions made, contributions to approved pension plan or deferred annuity, all capped at $60,000, the pension and so forth, any tertiary education, first-time homeowner allowance, all these things he could claim, but he cannot claim other expenses as would a sole trader in the conduct of his trade or business. Okay? As far as filing and payments go, just to remind everyone, payroll taxes, the statutory deductions are due to be remitted to the tax authorities. The Board of Inland Revenue is responsible for collecting the PAYE and health surcharge. The National Insurance Board is the body responsible for collecting the NIS contributions. All are typically due by the 15th day of the month following that in which the emolument income was paid to the employee. Failure to remit the taxes timely results in penalties and interest. In the case of PAYE and health surcharge, the penalty is 25% and interest at 20% per annum on the combined sum of the tax and penalty. And in the case of NIS, the penalty is 25%. If I'm not mistaken, the interest is 15% per annum. And this is on also the combined sum of the principal amount owed, principal contribution, and the penalty. But the NIS interest is computed a bit different to the PAYE and health surcharge interest. But for the purpose of this conversation, I don't think it is necessary to get that granular, but suffice it to say that there is a departure in how the interest is calculated for NIS purposes.
Colin, before you go into section 4,
Right.
I would want to invite some more questions.
Sure.
Yeah. I'm seeing here from Abigail Durant, and she's saying, I have my mom who is retired and my son who just turned 18 working with me. Do I need to pay NIS for family members?
So there's really no exclusion for family members, to my knowledge, but in the case of your mom who is retired, to my knowledge, the NIS will not be applicable. For your son, who is 18, he falls within the age limit eligible for the statutory payroll taxes to be accounted for, being the health surcharge and NIS. And of course, if his salary exceeds the personal allowance threshold, you would need to deal with that obligation as well. So once individuals are treated as employees and they are paid a salary for which pay slip is issued, then the statutory payroll taxes would become due.
Thank you very much, Colin. Aaron?
Yes, we have another question from Miss Hepburn. Is it necessary to provide evidence to the Board of Inland Revenue that you did not make enough money to pay necessary taxes?
And I'm assuming this question comes from the context of a sole trader. I would say, look, even if you did not make enough money to pay taxes, and when you say that, of course, you're referring to the personal allowance of 90,000. So your chargeable income, your net income was below that. Remember, you still have an obligation to account for health surcharge, right? And that is normally payable on a quarterly basis. And the health surcharge on a quarterly basis is 107.25 per quarter. You should not have income tax, and business levy would only apply, as I mentioned, where your gross income for the 12-month period was more than $360,000. So I would make the point that as a sole trader, you should still account for your health surcharge, file an individual tax return, and there's nothing requiring you to basically write to the board to request a reduction in quarterly installments in those instances, presumably because your situation would be where you're making below the personal allowance. So you would not have had chargeable income in the preceding year, presumably, on which you would have an income tax liability to base your quarterlies in the current year. I hope that helps, Ms. Abdul.
We have another question from Ms. Richel. How does an employed sole trader file tax by the 31st of March if you have not been given your TD4 yet by your employer?
Good question, Ms. Richard. So just to be clear, and just to reiterate the dates, the tax return is actually due by 30th of April of the year following the income year in question. So the tax return for income year 2024 is due 30th of April 2025. Now, there is an automatic 6-month period under the law to file your tax return, which expires 31st of October. So technically, you actually have until 31st of October to file your tax return without incurring a late filing penalty. The TD4 is required to file the return if your sole source of income is income from employment. I would say you should be empowered and entitled to ask a question to your payroll department, wherever you work, as to when you should receive your TD4, and indicate you would like to file your tax return. Now, let me just make a practical point here for everyone's benefit. One is currently the e-tax system of the Board of Inland Revenue, from my understanding, does not have the tax return forms up on the portal as yet. Last year, the tax return forms were not released until after April 30th. And a lot of people would be like, but Colin, you just said we have until April 30th to file the return. I mean, it is not a good situation for the tax authority to be issuing the e-tax forms after the due date. But as I mentioned, and I will reiterate, you still have until 31st of October without incurring a late filing penalty. Okay? But if you have any taxes to pay, be it a balance of income tax or business levy, then you should ensure that that is paid by April 30th, because that is the due date for payment of any balance of tax.
We just have one more question and then we continue.
Sure.
So we're taking it from Miss Jewel to
Sorry.
pay back a sole tax in a situation where you are employed by another institution, but you are a sole trader on the side. How are taxes paid out?
That's a very, very good question, huh? Because as an employed person, you have statutory payroll taxes that will be accounted for by your employer. As I mentioned, PAYE, NIS, and health surcharge. As a self-employed person, you will have to account for income tax on the income from your trade or business. How does the two interconnect? Well, on the one hand, I think we would appreciate that the personal allowance and the 70% NIS would probably be used by your employer in computing your PAYE on a monthly basis. So when you are computing your income tax, that should not be factored in from where I sit, assuming that your earnings and your employment arrangement would have used up the personal allowance in its entirety, the 90,000 and the 70% NIS. So on the individual side, I will say that on the sole trader side, you should take all your income, deduct all your expenses, claim any capital allowances. I don't know if you own assets that are used in your business, which could entitle you to claim the allowances and the capital allowances, and the net chargeable income position is what you will subject to tax at the rate of 25% insofar as it falls within 1 million TT dollars. If it exceeds that, then the excess is taxed at the 30%, as I mentioned.
Thank you very much, Mr. Ramsey. You may continue.
No problem.
Before you continue, Colin, I'm seeing two very interesting questions that I would just like you to touch on, especially one here on real estate agents. But the first one comes from Ms. Shamala Mohammed, and she's saying, just to confirm, if a sole trader has employees, the sole trader has to apply for health surcharge and PAYE accounts?
That's a very, very good question. The sole trader will register a business name normally and operate under the BR number of the individual. From employer perspective, I will say that under your BR number, there are certain account numbers that are assigned to you. So you will have a health surcharge number, you would have an IIT number, which is your individual income tax number, etc., etc. It is a question, to be honest, I will have to research. My thought process on it is there ought to be a differentiation between your health surcharge number on which your individual health surcharge contributions are made versus that in your capacity as employer. So my thought process practically is that the BIR should be in a position to issue you some form of a employer health surcharge account number on which you could then account for the health surcharge and so forth for your employees, as the case may be.
Thank you very much, Colin. And the final one is just as I'm looking, and I find that these two questions are very interesting.
It is very interesting, and it has me thinking a lot. So thank you for that question.
Not at all. And this one comes from Mr. Jason Moore, and he is asking the question, for real estate agents who operate on a strictly commission-based system, is health surcharge still required to be paid quarterly?
Yeah, I mean, look, the income tax, and thanks for that question, Mr. Moore. The Income Tax Act actually has various sources of income which are subject to tax. And Section 5 of the Income Tax Act lists those sources, and they include income from a trade or business, commissions, fees, licenses, income from employment. There are multiple sources of income that fall within the tax net of Trinidad and Tobago. So commissions, fees and licenses and all of these things actually do fall in the sources of income which are taxable. So the income that is earned from the commission is actually taxable. And because it's treated as income of an independent nature, because I assume in asking the question, the entity that you provide services for does not treat you as an employee and does not deduct any statutory payroll taxes from the amounts you earn. So that being the case, I would say, in my estimation, you would be required to treat with your individual tax obligations in the form of income tax, health surcharge, and business levy where applicable.
And this question from Nikki G. Is one required to pay NIS/health surcharge for persons who are temporarily subcontracted?
You know, that's a very good question. I mean, the Act defines the employment arrangements for persons and so forth. And just to go back to the foundation of how we started the conversation, where we indicated that in the case of a self-employed person or a person who is not an employee, the responsibility for accounting for their taxes rests with them. Whereas if they are treated as an employee-employer type scenario, then the responsibility falls to the employer. And then, you know, the statutory payroll taxes of PAY, health surcharge, and NIS become applicable. You know, the Act makes reference to different types of workers, casual workers, regular workers, and so forth. So, generally speaking, once the persons are treated as employees, and the Income Tax Act defines an employee as a person to whom the employer pays his remuneration, and vice versa. The employer is a person, or the employee is a person from whom the employer receives. The employer is the one who pays the remuneration to the employee, and so forth. Once that relationship is created, I will say that irrespective of the contractual arrangement, yes, the payroll taxes need to be accounted for. I will also go a step further to make the point that this is one area of tax where substance over form applies. And when I say that, what I mean is some people design contracts to avoid having to account for payroll taxes. So they may design a contract in such a way that it represents a contract for services, you know, one like an independent contractor, as opposed to a contract of services, which is an employment arrangement. There are cases to show that the courts will look at various tests to determine if the individual is a self-employed person versus an employee. And those tests at a very high level include the degree of control. Who has control over the working hours of the person? When he works? Where he works? The degree of integration. How integral is the role of the person to the overall organization? And in other words, is the individual a CEO that you're saying is under contract of services, I think we will all appreciate that CEO's role is such an integral role to an organization that it is difficult to argue otherwise, right? They will also look at what they call the economic reality test. Who is responsible for providing the tools of the trade? When the person comes to work, does he provide his own equipment, or do you provide the equipment to him? A laptop, a walker, or anything he uses on the job, right? Does the person get entitlement to sick leave, vacation leave? All these things are indicative of an employment arrangement, irrespective of how you design it contractually. So I'm just making the point. The last test is mutuality of obligation, the promise by both parties to perform future services. I'm just making the point that when you look at the test, the substance would override the form, the legal form. And I think we could come to the conclusion, based on the applicability of the various tests, that a person may be more of an employee as opposed to self-employed, which puts now the responsibility on you, the employer, to account for the payroll taxes. So let's not get too caught up in casual and temporary and, what is important is this person required to work under my direction, supervision, and control, and I have control over his hours and all of that to create that employee-employment relationship, in which case the responsibility then falls on me to account for his payroll taxes.
So, you are saying that as you just said, just to reiterate, we should not get caught up in the technicality of framing whether it is contractual arrangement or whatever. Once somebody is under your employ, then it is your responsibility to ensure that the statutory deductions are deducted from his or her salary.
Correct.
Yes.
I'm saying legally, and I'm not a lawyer, I'm an accountant, but I flirt a lot with the laws, you could tell.
Yes.
The recognition of the employee status from a title perspective would be important, perhaps from an industrial relations perspective and otherwise. So I don't want to underplay the importance of the title, but I'm saying when we're talking about responsibility for payroll taxes, let's understand what is the nature of the employment? What is the nature of the relationship? Is it an employment relationship where, in substance, the person is really an employee, but the contractual structure, the legal form of the contract may say otherwise? If you come to the conclusion that the individual is really an employee because of the various tests that I outlined, then it is in your best interest to get an assessment done, a professional assessment done. You come to a tax advisor and you say, look, these are the facts. Should I really be deducting PAYE here? And if the answer is yes, you are exposed because the Board of Inland Revenue, what's a good test too? A lot of people who operate under the pretext of providing supplies under a contractor arrangement may not even register for that. And then you ask yourself, well, why not? If they're crossing the threshold and they're getting paid by the company and whatnot, if they are truly independent and operate as such, are they accounting for their taxes individually on a quarterly basis? Are they registered for VAT and charged and issuing invoices to you with VAT? Sometimes when you look at the fact pattern, you realize, oh gosh, no, the person I'm doing all of that, I pay him technically. He kind of like is an employee of mine. And so in that instance, I think, the exposure would be with the person paying the individual because they could be seen as the employer in substance.
I like that answer. So even though someone may be contracted to conduct business on behalf of the company, it is still the responsibility of the contractor, meaning the employer, to ensure that tax and NIS and health surcharge are deducted from the person, and
Well,
not assume that the person would be responsible for his or her statutory deductions.
yeah. So just to clarify that, Mark, I think it is important for the person to get an assessment and a thorough assessment done of the situation before assuming that there are no responsibilities from a payroll tax perspective, notwithstanding the legal form of the arrangement.
Yes,
I
because you
think
can run into problems there.
correct. And we've seen it. We have actually seen the Board of Inland Revenue audit clients of ours in some cases where the contractual arrangement was not clear. I mean, it was akin to an independent contractor, but in substance, there were employee type, characteristics which led the BR to impose PAYE and health surcharge and NIS. Well, not NIS, because the BR doesn't deal with NIS, but PAYE and health surcharge. And they say, look, you are the employer, you are de facto the employer in this situation. So I'm coming to you for my taxes. I'm not going to him. I'm coming
Yes.
to you as the employer.
Thank you very much, Colin. And I just want persons to know, it's not that we are overlooking anyone's questions. There are a lot of questions coming in, and more than likely we would not be able to ask all of them. So please don't feel slighted in any way whatsoever. We are just trying to get an appreciation of persons' questions in the chat, but we would not be able to ask everyone's question. So last question to you, Colin. It's now 8:06, and it comes from Rishma Lali Hari, and they are asking, if my business was registered, but I was not operational until some time later, how should I calculate the health surcharge period, as I am not in the tax bracket?
Well, if you generated no income because you were not operational, then there would be no need to account for health surcharge until such time that the business actually became operationalized and income was generated, which would then make you liable to the accounting for the income tax and the health surcharge and so forth. So I would say for that period that you were dormant, essentially not trading, then that should be fine. There should be no need for you to account for health surcharge in those circumstances.
Thanks very much for answering that, Colin.
No problem.
You can. So it's now 8:07. So
yeah. So
we're
let me
very
just
close. So you can jump back into the presentation.
Sure. Look, a lot of this, what we're about to cover, we have gone through before. This is really just to reiterate. So VAT is a tax charge on the sale of, goods or services, and it basically is on commercial supplies. That's the correct technical term used under the VAT Act. And the companies and businesses act as agents to collect the tax on behalf of the government. So it's an ad valorem tax, meaning you charge VAT, collect it, and pay it over to the Board of Inland Revenue. The VAT is due, well, the VAT period would normally be, if we start with the far right, every 2 months, and you're required to file the VAT returns by the 25th day of the month following the end of the VAT period in question. Generally, you apply for VAT registration where you expect your commercial supplies to exceed the registration threshold of $600,000 in a 12-month period. And once you do that and you meet the satisfaction of the Board of Inland Revenue, you assign a VAT number, which makes you eligible to charge VAT. But in addition to charging VAT, and the standard rate of VAT is 12.5% in Trinidad for everyone's knowledge, anything that is zero rated attracts VAT at 0%. And there are quite a few goods and services that are zero rated. So, for example, basic food items are zero rated, international freight and ancillary services is zero rated. Certain types of equipment used in the energy sector, they are zero rated. Recently, the government made amendments to the VAT Act to allow certain types of vehicles, CNG vehicles, hybrid vehicles, within a certain age limit to be zero rated. So, and zero rated means you are still eligible for VAT registration because you are making commercial supplies. However, the rate of VAT applicable is 0%. Okay? So as far as issuing invoices go, the VAT Act is very prescriptive. It tells you the characteristics of a tax invoice. So when you issue a tax invoice, it must bear, for example, the VAT registration number of the employer. It must have an identification number, serial number. It must have the name of the payee, an address of the payee, the amount of consideration for the supply before VAT, the VAT, and then the total value of the supply. The VAT Act is very prescriptive, and you ought to be guided by that once you're VAT registered and issuing invoices with VAT. Okay, so basically that covers VAT. So again, the payment of VAT. I just want to touch on a couple of very important points here. Where the output VAT exceeds the input VAT, you end up in a VAT payable position. And that VAT payable is due by the 25th day of the month following the VAT period. So as I mentioned, VAT periods are every 2 months. So, for example, the VAT period January to February would have been due for filing with the Board of Inland Revenue by the 25th of March, 2025. And any VAT payable, i.e., where your output VAT exceeds your input VAT, would have been due for payment at that time. Okay? Now, if the reverse occurs, meaning your input VAT exceeds your output VAT, you end up in a VAT refundable position. And VAT refunds have been a bit slow to come by in Trinidad and Tobago. In recent times, the government actually issued VAT bonds in lieu of VAT refunds for persons who are owed VAT refunds in excess of $250,000 per VAT period and above. VAT refunds of a lower value were issued by way of VAT refunds. And I will tell you, as a tax professional, hundreds of VAT refund checks crossed my desk in the last month. Hundreds. So it means, and this is good, I smile when I see them because it tells me the government is living up to their side of the bargain by issuing the VAT refunds of smaller amounts to taxpayers, which is much needed because VAT refunds are a form of cash flow to a company, and especially for small to medium-sized businesses, the timely receipt of cash is critical to the success of the business. So we know how much pain it could be for small to medium-sized businesses who are owed VAT refunds and it's not issued timely. And I also empathize with the foreign exchange situation for those of you who may need foreign exchange to keep your business afloat, because it is really a challenge currently facing the country. So the point I'm making is for VAT, you have the ability to pursue VAT refunds. It may not be timely, but eventually will be issued, provided that you are not selected for audit. And even if you are, and the BR audits you and your books and records are clean, which is number 6 on the screen, the importance of record keeping. Once you have clean records, you should be able to get your VAT refunds issued shortly after the audit. And, maintaining books and records, as I mentioned, should be for 6 years from the end of the year of income, or 3 years from the date you file your VAT return, whichever is later. And these include invoices, receipts, ledgers, the VAT returns filed. All books and records should be maintained in Trinidad and Tobago at your place of business. The other point I will make, and this is important, guys, for those of you who are applying for VAT registration, when you are VAT registered, your VAT certificate has to be displayed publicly in your place of business. Understand that it is not to go in a drawer or a file with your BR number or your NIS certificate. And the VAT certificate is actually an offense under the VAT Act to not display your VAT certificate publicly at your principal place of business. And I would like to challenge those of you who have your businesses to put on your tax caps now that you have been armed with this information and educated. And when you walk into businesses, just look around. Any business that you're accustomed shopping at, look around at the groceries, at the retail stores. I guarantee you, somewhere in that business where there are frames hanging up, you will see VAT registration certificate and VAT registration number XXXXXX. And that is by law required. So just be aware that once you're applying for VAT registration, get your nice little frame your VAT certificate, and hang it up proudly to show that you're VAT registered. All right. Am I missing anything? Just to reiterate that if you pay VAT late, the penalty is 8%. Interest accrues at 2% per month or part of a month. That equates to 24% per annum. And there are certain goods and services that are zero rated and others that are exempt, which we would have discussed during this webinar at length in the past. So I don't know that I need to revisit that at this point. So I'm just going to shift gears to the final part of the session, which is just a high level on property taxes. If that's okay, Mark, I don't know if we want to pause for 2 more questions before we wrap up on the property tax side.
No, go ahead, Colin.
Okay. Cool.
Yes.
No problem. No problem. So, property tax, the dreadful property tax, as many people described it in the past. Let me start by saying that property tax has always been on the books really in Trinidad and Tobago, just under different name, right? In the past, you had land and building taxes and house rates that would have been accounted for. And then from 2010, property taxes stopped being collected. So the last time the property tax was collected was for 2009 and prior, under the previous Land and Building Taxes Act and Municipal Corporations Act, I think Part 5, which deals with house rates. Recently, the Property Tax Act 2009, which has been legislated and on our books for quite a number of years, was reenacted, and the property tax started, or the collection resumed for residential properties last year. Now, property tax generally works in a way where the assessment is issued to you by 31st of March, but you have until 30th of September to pay. Because last year it was resumed and there were many teething issues with the resumption of property tax, the deadline for issuing the assessments and receiving the payments were extended. But once these issues are resolved from this year, 2025, and I'm speaking to you here, and what is going through my mind is the fact that today is already the 19th of March, is it?
Yes, it is.
And I'm not sure that I am aware of property tax assessments being issued for 2025. So I suspect there may be some further extensions. Don't quote me on that, please. But I suspect if the assessments are not issued by the statutory deadline of 31st of March, there would be consideration for extension similar to 2024 for the issuance. Now, how does the property tax work? The property tax, it is levied on rates depending on the classification of the property. So residential properties attract a rate of 2%. It was previously 3%, but reduced. And commercial 5%, industrial property 6%, and 3% for open air plant and machinery, and agricultural 1%. As I mentioned, property tax is not currently enforced for commercial, industrial, or agricultural properties. So the focus right now is on residential properties. And so what happens is you take the annual rental value, which is the rent you expect to get for your property, given the size and location and whatever. That rent is extrapolated over a 12-month period, and the rate and discounted by 10%. And then the rate applied on that discounted value, which is the annual taxable value, right? So on the screen, you will see an example. If my property could be rented for $5,000 per month, then over a 12-month period, it will fetch $60,000 per annum. I then apply my 10% deduction, which would be $6,000. From that $60,000, it comes down to $54,000. And then when I take 2% of that, it gives me $1,080 per annum is what my property tax bill would be. And if I divide that by 12, it gives me $90 per month. So it's really not as draconian one may have originally thought, barring the awareness that was just created in how the property tax is computed. Okay? And there are provisions. I mean, as I mentioned, property owners are required to file their property tax returns. In fact, what happens is you get an assessment and you go to the Board of Inland Revenue, you pay, and you get a receipt, and that takes care of that. And as I mentioned, that should normally occur by 30th of September. So basically, you have 6 months from the time you receive the assessment to go and pay. But as I said, today's the 19th of March. I haven't received calls from people. Being a taxman, people do call me regularly for all types of tax matters. And I haven't heard anyone really come a lot with the property tax assessment. So maybe I'm speaking early, but let's see what comes out of it. But the 31st of March is the timeline for which the board should issue these assessments by. And then you have until September, and then there are certain exemptions for property tax for institutions such as churches and places of worship and schools and so forth, and certain recreational grounds. Failure to pay property tax on time leads to a penalty of 10%. And interest accrues thereafter at 15% per annum. There are legal action the government could take where you delay or renege on your responsibility to pay property tax. There are quite a number of steps to get to that point, but it could lead to a point where the government may levy a discharge or warrant on the property and so forth. But as I said, that is not something automatic. It doesn't get to there immediately. You have to be given notices and follow-up notices, then demand notices, and it is a process to be followed before it gets to that. And from a dispute perspective, just to make the point that you could dispute a property tax assessment in different ways. Well, one, on the basis of valuation. If you disagree with the valuation, you could object in writing, and there's a specific form that you use to object to the valuation. And the time frame for objecting was recently increased from 30 days to 6 months. So imagine that you have a long period of time to object to a valuation for property tax purposes. In the case of a property tax objection for the calculation of the assessment, then that is done within 21 days that the tax becomes due and payable. So you basically have timelines to adhere to for your objections to be considered valid. And that, before I go to Q&A, I just want to make one point, because I did start the conversation saying this property tax was really meant as a refresher. I mean, a lot of this, in fact, all of it would have been covered in the session Mark and I did last year, along with Risa. But also to make the point that under the Income Tax Act, land and building taxes are, in fact, deductible in computing your chargeable profits. So as a sole trader, if where you operate out of, you pay the property tax, because the Act does actually make provisions for lessees to pay property tax in certain instances and deduct it from the amounts due to the lessor, as the case may be. But if you incur that cost and it's part of your business arrangement, then the property tax ought to be deductible. The other point I will make is, under the Income Tax Act, there were provisions that required taxes under the old Land and Building Taxes Act and Municipal Corporations Act to be paid in order for you to claim wear and tear allowance. So remember all the assets we talked about, the land and building. Once you own it or incur expenditure in constructing it for use in the trade or business, you could claim wear and tear allowance. For buildings, it is 10% on a reducing balance basis. I will say that for you to be eligible to claim the capital allowances, there is a requirement under the Act that the property tax be accounted for. So that makes it even more important and relevant, particularly in instances where you are a sole trader and are desirous of claiming capital allowances on buildings that you are using in your trade or business that are eligible for the wear and tear allowance. So with that, I turn over to any further questions.
Thank you very much, Colin. And as promised, ladies and gentlemen, very, very informative session this evening. Thank you, Colin. Thank you, Risa. I just have 2 questions on property tax, and I am very happy, Colin, that you address the question of being non-compliant in terms of paying your property tax, because after our webinar last year with property tax, the amount of comments we received on our Facebook page and persons opting not to pay because they found it to be oppressive and all these things. I would want to personally advise people to adhere to the law and pay your property tax, because even though it may seem to be a long drawn-out process, you don't want the government to come and seize your property and you remain homeless. So let's adhere to the law. Let's and do our duty as a citizen. It is now 8:27, so I'm just going to give you these 2 questions. And this one comes from Shakila Daniel. And does someone who owns residential property, but there is no homestead on said property, have to pay property tax?
Yes.
That's a good question. I mean,
Yes.
And when you say no homestead, I mean, forgive my ignorance, you know, if you could elaborate on that, because I mean, the Property Tax Act actually places the onus on the owner of the land and building to
Yes.
account for the property tax, right? So basically, I think it will go back to whose name is listed on the deed of ownership and all of that to determine the entity that is responsible for the property. So if the property no longer has a house after it was, I'm seeing there was a question, there was a chart there, it just disappeared. Just 1 second.
While you're looking, I would just like to take
Yeah,
the
house
opportunity
after.
to invite persons. Maybe you asked a question and there are questions that were unanswered. I'm inviting you all to post your questions on our Facebook page. We will refer these questions to Colin and to Risa, and they would respond in a timely basis, and the answers to your question will be posted on our Facebook page, because we don't want to have anybody left out.
Yeah, so good question, Shakila. I mean, I think the property tax would be based in that instance on the value of the land and any building structures or appurtenances attached to the land, which would include the shed that stores the tools. So yes, the property tax would be on the value of the land and that structure that is on the land.
And I think the other question that on the property tax by Mrs. Simmons, good night. If the property no longer has a house after it was assessed, do you pay property tax? The property has a shed or a store.
That was the same.
So you would have just answered that question,
Yeah,
yes?
sorry, that was the one I answered. But for Shakila's question, which she spoke about, I think a homestead arrangement. The issue is ownership, and even though the act makes reference to the occupier of land being required to account for property tax in certain instances, generally the obligation falls to the owner of the land and building. So the key is to understand who is listed as the owner in those circumstances, and if you are an occupier, then to work out with the owner how the property tax should be dealt with, because somebody is going to have that responsibility to deal with the property tax where the land is demarcated as residential purpose land, which is currently what is being assessed and focused on by the government, as you know.
Thank you very much, Colin. And I want to thank our participants for studying the course with us, for coming right down to the end. I also want to invite all of you to join us tomorrow for part 2 of Entrepreneurs and Taxation with myself and Colin and Risa. And also we are also going to have our accountants tomorrow, please God, also presenting on our entrepreneurial spreadsheet. This is a spreadsheet that our credit union designed specifically for Westview's entrepreneurs. We would have mentioned before that bookkeeping is very important. It is critical. I would have mentioned it, Colin would have mentioned it more than once in his presentation, that bookkeeping is very, very critical in terms of filing your tax, but also when you come to have a credit conversation with our credit officers, having accurate information on your business as an entrepreneur is very important. So they are Andre Matthews and Fanilla Sam. They are going to be doing a presentation on our entrepreneurial spreadsheet and how you can plug your figures in. And we also offer free services at the Organization for Entrepreneurs, and the accountants will sit with you and put your information together at the start, and then after they would just monitor and guide you along thereafter. So I once again want to thank you, Colin. I want to thank you, Risa, for your expertise and your hard work as usual, and taking the time to come and educate our membership and the wider population of Trinidad and Tobago. I want to thank you, our participants who stayed with us, who decided to take the time out of your busy schedule and come and share with us throughout this, excuse me, this important webinar, Entrepreneurs and Taxation. So thank you. I am Mark Ferret, your president, and I wish you all a good night, and we will see each other tomorrow, please God, again for part 2 of Entrepreneurs and Taxation. Good night.
Thank you, everyone. Good night.